Good afternoon, everyone. Thank you so much for joining us. My name is Genevieve Goldleaf. I'm the program assistant for the Carrot Project, and we're going to look forward to Julia Shanks' presentation on basic accounting for farmers, hosted by the Carrot Project. Before we get started, I'm just going to talk a little bit about the Carrot Project and introduce Julia to you. So the Carrot Project is a nonprofit based in Boston that provides financing and business assistance so that farm and food enterprises thrive. We offer specific programs for loans and financial technical assistance to farm, forestry, and fishery businesses, and to processing, distribution, and storage enterprise businesses with any type of local agricultural product. We work with businesses at all stages, from pre-startup to mature, including those who are having trouble obtaining financing elsewhere, such as startups and beginning farmers. That said, businesses that already have a working business plan are ideally suited to apply for a loan or technical assistance with us. Our capital or operating loans range from $5,000 to $75,000 at 4.99 to 7% interest. Applications are due the first business day of each month, so our next application cycle begins December 1st and January 4th. It typically takes about 8 weeks from the time a completed application is received to you having funds in hand, but you can start working with us earlier than that. So if you're interested in working with us in this coming season, please get in touch soon. The free technical assistance services that we offer include assistance preparing application materials, developing cash flow projections and enterprise budgets for new projects, reviewing business plans, evaluating financial options, and determining business profitability, growth, and direction. We are sometimes able to work with non-borrowers in our service areas to provide other kinds of TA. So please feel free to get in touch anyway to find out if you're eligible. Those regions that we serve are Maine, Vermont, Massachusetts, and the Hudson Valley. Outside of our technical assistance and loan programs, we also conduct research and collaborate on trainings. Some of our current work includes offering Train the Trainer sessions to include the quality of financial technical assistance that's available to farm and food enterprises, sharing our financing models, and ongoing research that demonstrates the impact of financing and business assistance on small farm viability. If you would like to find out more about our programs, please check out our website, which is thecarrotproject.org, as you can see on the screen, or contact our loan and business assistance coordinator, Benneth Phelps. Her email address is bphelps@thecarrotproject.org. We also have another person from the Carrot Project joining us on the call today, Sarah Cogswell, who will be available to answer questions about along with me, with the Carrot Project programs afterward. Okay, so with all that said, it is my pleasure to introduce our presenter today, Julia Shanks. Julia is a Cambridge-based chef and entrepreneur who consults with food businesses and farms, preparing them for growth through business and cash flow planning and financial feasibility studies. Her clients include Mother Earth Produce, Skinny Dip Farm, the Massachusetts Department of Agricultural Resources, and City Growers. She lectures on sustainable food systems and restaurant accounting, sits on the advisory board of Future Chefs, and is the regional leader of Slow Money Boston. Julia received her professional training as a chef at the California Culinary Academy in San Francisco, her BA from Hampshire College, and an MBA magna cum laude from Babson College. We are very, very glad to have her with us today, and you guys should have a great presentation from her, so thank you so much for joining us, Julia. I'm going to let you get started in just a minute, but I just want to go through how we're going to structure the webinar today. So when Julia is giving her presentation, she will be pausing for questions a couple times during the presentation, and then we'll have more time for questions at the end. If those of you who are on the call, if you have questions, please type in your questions through the chat function on the GoToWebinar thing, so I'll be able to read those to Julia while we're going along, and then if there's others left over, we'll get to them afterwards. And also, if you could save any questions that are specifically about the Carrot Project until afterward, we'll be able to take the time after the webinar to discuss them then. And the last thing I want to mention, there will be a really quick survey that will pop up when you close out of the webinar. So if you could just take a minute to let us know what you thought about the webinar and what we can think about doing better next time, that would be really wonderful. Okay, I think that's everything. So thank you so much again for joining us. And without further ado, I will turn the floor over to Julia.
Thank you, Genevieve. and thank you, Carrot Project, for having me. My name is Julia Shanks, and I am one of the TA providers for the Carrot Project. I work with a lot of their farmers, helping them get ready for business loans and help them with business planning and cash flow planning. I want to just put out a few disclosures before we get started. This is going to be a really numbers-intensive webinar. In the previous webinars, which hopefully you've all seen before, we take a pretty high-level view of the numbers. Today, we're really getting deep into the muck of the numbers. So, one, the numbers are consolidated. Two, I've modified them to make points. So sometimes it may be a little bit harder to read than some of the other webinars. So I apologize for that, but I'm doing my best to make it as readable as possible. And finally, as you plan and project for your own business, you're going to need to research your own financials based on your economic reality. Don't look to these numbers here as truth. You'll need to look at your own business. So we're going to go over the goals of this webinar. We're going to review the income statement, the balance sheet, and then we're going to talk about budgeting and cash flow planning. So oftentimes when I start working with farmers and entrepreneurs, the first question they ask me is, how can I grow my business, or how can I improve profitability? And that's really the end game, and we've been working to get there based on the previous 3 webinars. We started with a basic understanding of accounting. We've been developing our systems of tracking our finances, and now we're finally able to start to track and measure our progress. So we're really on our path so that we can start to plan for growth and profit. So today we're going to talk about evaluating the health of your business by reviewing the income statement. We're going to use the balance sheet to understand your cash flow, and we're going to talk about some tools that you can use to better manage your cash flow on a day-to-day basis. And hopefully nobody's head will explode with all the numbers. So first we're going to start with the income statement. And the income statement is a summary of your operating revenues and expenses. And it helps you understand the profitability of your business. It allows you to understand the nuances of your different product lines. Perhaps you're selling meat birds and eggs and vegetables, or you're selling at farmers markets and wholesale, so it can help you understand the different ways that you sell your products. And it can also help you to project your profitability in the future. It can help you with business planning and cash flow planning. And of course, the dreaded taxes, which you must file. It's typically based on a period of time. So you can look at your income statement for a month, a quarter, a year. And it's important that you focus the income statement on the activities that directly relate to the operation of your business. There are a lot of extraneous operations that go on in your business, and you want to make sure that you're really focusing, not just that you're focusing on the operations, not on the investments or the financing activities that go on. So next, we're just going to focus really on understanding the profitability of your business. And net income doesn't equal cash flow. We're going to talk about that in a minute, and that slide seems to be a little extraneous right here. So when you're trying to troubleshoot profitability, there's a lot of information in your income statement, and oftentimes entrepreneurs don't really look at their income statement until they're trying to figure out what's going on. And you can hope for something magical to happen, or you can start to dive deep into the numbers. So when you're troubleshooting profitability, there are different places where you can look on your income statement. Is your revenue, is it going up or down? Are your COGS, your cost of goods sold, are you marking up your products enough? We're going to go into all of this in more detail in a bit. You can look at your operating expenses. Where are your major expenses? Where can you save money? Is your operating profit positive or is it negative? And what are the other drivers in your income, in the other income and expenses? So we're going to look at those in more detail in a few minutes. But before we go into that detail, I want to show you what not to do. And this is what I call the Schedule F income statement. And a lot of farmers will create their income statement based on the Schedule F form. And move that away so you can actually see it. You know, they have their farm income on top, expenses on the bottom. The expenses are alphabetized. It's very simple. It's straightforward. It's neat. You can file your taxes. But there are a couple of problems with this. The first one is that grants are included in the revenue. And this is a problem for two reasons. One is it masks what your income is. You know, it looks like, wow, your income really grew in 2010, but it didn't. It grew a little bit, but now you have to back out that $25,000 to see how it grew. So it doesn't really show an accurate picture of how your revenue is growing over time. The second thing is that when you try to compare year-to-year expenses, you're going to have a skewed sense of how your expenses are relative to your income. So as an example, if the feed expense is compared as a percentage of income, it looks like it really dropped as an expense in 2010, when in fact it probably didn't. But again, the numbers are skewed because the grant is rolled into the income. Now, like I said, you can obviously back out the numbers. It's not that hard, but no need to make it too complicated for yourself. The other challenge is that the expenses are just aligned to the Schedule F and not to your reality. So as an example, if you want to understand the direct costs of your animals, you can see that the feed is on the top and the veterinary expenses in the bottom, and you have to sort of pull out the numbers to see, what am I spending on my animals? Similarly, you don't really know what the insurance expense is. Is this liability expense? Is it vehicle insurance? Is it insurance for your employees, such as workman's comp or unemployment insurance? And each of those numbers relate differently to your business. And as you try to think about the different costs in your business, you're going to want to know, well, is my insurance expense high because of my vehicles, or is it high because of my employees? And where's the money going? And on a similar vein, the taxes are all lumped together as well. So we don't know if this is payroll tax, which is related to employees, if it's property tax, which is related to the cost of being on the land, or if it's income tax. So again, a lot of the nuances of your business are lost in this format. So what I suggest is that you reorganize your income statement in a way that you can extract meaning. And we're going to go over this line by line. And I know that sometimes people are concerned about this method because how does this align to the Schedule F, and how am I going to file my taxes, and how much harder is it going to be? And it's really not that hard. Most of these expense categories align pretty easily with the Schedule F, and any accountant who's filing your taxes on your behalf and worth their salt can help you do that. So first we're going to talk about the revenue. And the revenue is really just the net sales from your business. It is what did you earn from selling your products, whether it's meat, eggs, dairy, yarn, the money that you earned from selling your products. And it's not the money that you got from a grant, and it's not the money that you earn from, let's say, renting out part of your greenhouse. That's separate, and we'll get to that at the bottom. The next line is the cost of goods sold, and these are the costs that the expenses for purchasing products that you resell. So for example, if you have a farm store and you purchase a local supplier's jams and jellies to sell at your farm store, if you're buying somebody else's meats to sell, that's what's going to be in your cost of goods sold. And the first point of analysis is really in the gross profit, and gross profit is revenue minus cost of goods sold. And after you pay for these goods that you're reselling, what do you have left over to pay your other expenses? And this can be a good point to look and see, am I marking up my products enough in the farm store, or if you're reselling products at the farmer's market, are you making enough of a profit on these goods? Are you pricing properly? Are you paying too much? So you can really learn a lot from looking at the gross profit number. Next, we have the operating expenses, and I recommend breaking them out into 5 different categories. The direct operating expenses, this can also be the cost of production. Labor, how much does it cost to have your employees working for you? Occupancy, what does it cost you to be on the land? This can be rent, this can be property taxes, this can be your utilities. General and administrative is really just the overhead, and the repairs and maintenance. And I really like to call out repairs and maintenance specifically because it can give you some insight into how old your equipment is it time to replace it, how much money are you spending to maintain your equipment, and at what point do you need to replace it. And if you're watching that number increase, it may be time. The next line is the operating profit or operating income, and that's the gross profit, which we saw up above, and hopefully you can see my mouse right here, minus the expenses, which are right here. So this operating income, it's not the bottom line, but it gives you a sense if your core operation is making you money. If through the basic operations of your business, are your revenues exceeding your expenses? Now, after that, we have what's called the line, and you may hear people talk about top line, bottom line, above the line, below the line. The line is basically here, and it's separating the operating income from the other income and expenses. So for tax purposes and for proper accounting, you may want to have certain things on your income statement, but they're not directly related to the operations of your business, and you want to separate them out so that you can really have a clean picture of what your business is doing through operations and still capture all the other little bits and pieces. So other income and expenses is going to include the money that you get from grants. It's going to be depreciation expense, which we'll talk about a little bit later on. Interest expense, if you're paying interest on debt or on credit cards. While it's sort of related to your business, it's not quite. And then finally, we have the bottom line and the net income, which is the total revenue minus all your expenses plus the other income that you receive minus the other expenses, and what do you have bottom line? So here's an example of an income statement, and I'm showing it in 3 columns just so you can actually see it all. And you can see that we have the 5 basic categories: the direct operating expenses, the payroll, general and administrative, repairs and maintenance, occupancy, other expenses here. So we're going to go through this now and talk about how we can extract meaning from all these numbers. One of the best ways to extract meaning is what I call common sizing the numbers. So, here's an example of somebody's payroll figures. Total payroll one year was 51K, next year 57, 61. Payroll is increasing. Should we be concerned? I don't know. It really depends, and it depends very much on revenue. So we can see here that, once we start to layer in the revenue, you can see, all right, well, revenue is increasing, so yeah, that makes sense that the payroll was increasing. But what we can also do is we can look at payroll as a percentage of revenue. So, for example, in the first year, 51,000 divided by 163,000 is 31%. In the second year, payroll as a percentage of revenue was 32%. And in the following year, it was 33%. So on the surface, it looks like, yeah, revenue's going up, payroll's going up. Yeah, that kind of makes sense. But when you look at it as a percentage, you can see that payroll is actually increasing as a percentage of sales, as a percentage of revenue. And intuitively, that actually seems wrong. It probably, you increase your volume, you think that the payroll will become more efficient, you'll need less. So it gives you a point to look at to say, what's going on in payroll? It's starting to increase. So I want to keep my eye out on that. Make sure that I don't get myself in trouble. So we can start with the top line, and what we're basically going to do is we're just basically going to go down this income statement here piece by piece and look at the different places. So the first thing we can do is looking at the revenue. When we're trying to understand the profitability of the business, we want to see, well, how is revenue changing year over year? So in the first year, this farmer had $163,000 in revenue, and it grew in the second 2 years. The second year, in 2014, it grew by 8%, and in the third year, it grew 6%. So while the business is still growing, it's not growing at the same pace. So this farmer is going to want to think about growth strategies for the coming year. So if the growth is not increasing at the same rate as it did before, what can this farmer do? If it's her goal to increase even more, she may need to extend her acres in production. She may need to introduce new product lines or new products. So she's going to need to think about different ways to increase her revenue beyond just organic growth, because it's starting to slow down. The other thing that she can look at is the sales mix. So we can add a column to say, well, how is her sales mix changing over time? And it looks like her farmers market sales are decreasing and her CSA and wholesale are increasing. So now she's got a little bit of an insight into how the numbers are changing. She can ask, well, why did the CSA number increase and why did the farmers market sales decrease? And what can I do to change that? And do I want to change that? So now you're getting some insight into how the business is changing and evolving. You can ask yourself why and what do you want to do about it, and how does this impact your decision for how you want to plan in coming years. This particular farmer is reselling some products at the farmer's market. She's selling her own goods, her own produce, but she's also bringing in some others. So the cost of goods sold for her is relative to the farmer's market sales. And so in this case, I'm going to look at the cost of goods as a percentage of the farmer's market sales. And again, we can see that the farmer's market sales are increasing, the cost of goods are increasing, but they're increasing at a greater rate. So you can see that the percentage of sales is 22%, then 25%, and then 26%. So what that is telling me is that the farmer is not marking up her goods relative to what she's paying. So as an example, let's say she's buying tomatoes from another farmer for $20 a case and she's selling it for $30 a case. In a subsequent year, maybe the farmer is selling her that same case of tomatoes for $25. This farmer didn't actually raise her prices. So by looking at the cost of goods as a percentage of the sales revenue, you can keep an eye on whether you're raising your prices properly according to what you're buying your goods for. Okay, I'm going to switch over to my Excel spreadsheet. On a second. Okay, so this is the actual full spreadsheet right here. And it can be a bit overwhelming. And what you see over here in these columns right here, can you guys see my mouse? Jenny, can everybody see my mouse floating around? Okay, great, thank you. So this column right here, I'm taking the percentage of each line expense relative to the revenue. So as an example, this equipment is, total equipment expense over total revenue. And similarly, this number right here is total seeds and plants over total revenue. So what I do is I look down these numbers at the percentages, and I look for places where the numbers jump out at me. And where I've highlighted in yellow, these are places where the numbers seem high. Here, the farmer spends 3.9% of her revenue on mulch and black plastic, and that seems really high to me. So as an advisor, I would suggest that she look into that expense. Is she buying from the most efficient vendor? Is she not buying in bulk when she should be? Is she buying too much? What's going on here? That seems really high. The supplies also seems high at 5%. And what happens is a lot of farmers will just glom everything together into one category called supplies. And for such a large percentage of sales, it's hard to see where the money is going to. And if the farmer feels like she's having trouble increasing profitability, she's going to want to dig deeper into this number to find out, is there any extraneous expense? Is she spending too much? Maybe she's buying tomato steaks every year when she could be reusing them for a few years. Similarly, the labor is a very high percentage. For small diversified farms, this is actually pretty normal to see labor at that level. But again, it's a high percentage of her revenue, so it's worth keeping an eye on. Gasoline was high, so this might pretend that she's doesn't have a very efficient vehicle, or maybe it's gasoline for the tractor. So again, these are numbers that you want to keep an eye on. Finally, I want to call out the depreciation. So the depreciation expense is a way to allocate the value of the assets that you've purchased over time. So for example, if you buy a tractor and the tractor costs $10,000 and it's good for 5 years, you're basically using $2,000 worth of the tractor's value each year. So your accountant can help you figure out the depreciation expense every year, and there's certainly tables available. One of the things about the depreciation expense is that it's a reminder that this is how much money you should be saving to replace your equipment. The depreciation tells you how much value you've used up of your equipment, so presumably when you've used up all of its value, it needs to be replaced, or soon after. I know there are plenty of farmers that are going to use their tractors far longer than their quote-unquote useful life. But it's a reminder that you need to start saving. And if your net income, your bottom line, is positive, then that suggests that you actually have the resources here to maybe set aside some money to start saving for replacements. And I think what we're going to do is take a quick break for questions. Does anybody have any questions? What if grants are given for a multi-year project? So what I would suggest is that, again, the grants need to be recorded in the other income, but you can also put the grant in an asset account on your balance sheet. So you have the money there, but it's not money that you can spend yet. And you can then, if you're tracking this in QuickBooks, you can make a journal entry to say every year, I'm going to move the money off of the balance sheet and onto the income statement. So you can hold it on the balance sheet so it kind of levels off the revenue from, or the income from the grant by keeping it on the balance sheet. Any other questions? Okay. So next we're going to talk about the balance sheet. So the balance sheet is, again, one of those things that entrepreneurs have a really hard time with, but it's really helpful for lenders to see your financial position. And believe it or not, it can help you in cash planning, and it can help you understand the changes that are going on in the business. As an example, why don't you have cash in your checking account even though your income statement shows a profit? The balance sheet is a snapshot in time. Unlike the income statement, which covers a period of time, the balance sheet is just a snapshot. What do you have on this day at this moment? And who do you owe money to? And what do you own of your assets? The balance sheet is an equation. It's assets equals liabilities plus owner's equity. And the assets are what you have. The liabilities are what somebody else has a claim to. And the owner's equity is what you have a claim to. And if you turn it on its side, it's your balance sheet. So here's an example of a balance sheet, and we have two balance sheets side by side, one for the end of 2010 and one for the end of 2011. So we can see total assets equals total liabilities, just as a confirmation point. When we look at retained earnings, the retained earnings is the ongoing tracking of how much profit the business has earned. So we can see that from 2010 to 2011, the retained earnings increased by almost $42,000. So that means that the business earned $42,000 in income in 2011. We can also see that the cash balance decreased. And this, may be of a concern for the farmer, depending on, what's going on in the off season. To have $11,000 in cash going into January may or may not be a problem. We also have an idea about leverage. We can compare the total liabilities to the total assets. And lenders especially are looking at this number, and it can be helpful for the entrepreneur to know as well. That you can see that of your $179,000 worth of assets, what do you own and what does somebody else have a claim to? So of those $179,000 worth of assets in 2011 that you have, only $12,000 is a liability, which means you own most of your assets. And we can look at the equity and we can see that you were able to acquire these assets by investing your money into the business and by earning money. You earned $99,000, you invested $67,000, and with that money, you were able to purchase all of these assets that you have with a little bit of help from a loan. But you can see that the cash did decrease, $20,000 from 2010 to 2011. And that can be a little bit nerve-wracking going into the winter. So you want to know, where did that money go? The farmer showed $40,000 in profit, which we could see here from the change on the balance sheet. But where did that money go? It only had $20,000 loss in cash balance. And we can see that it was from the purchase of all this equipment here. Now, this is the change from 2011 to 2012. So you see, for example, that the farm stand, the value of the farm stand increased by $4,300. And what that means is that the farmer invested $4,300. The farmer invested $4,300 worth of infrastructure and equipment into the farm stand. Maybe they put on a new roof or new shelving, but they increased the value. So that's where the money went. They put $4,300 into the farm stand. They purchased a new greenhouse for $10,800. They purchased new fencing and they purchased new vehicles. So this decrease in cash right here of $20,000 is resulting from all of these purchases here. Now, we can see here that we had $40,000 in retained earnings increase. So the money that the farmer earned into the decrease in cash is what was financing these purchases. Here's an example of another balance sheet. And now on this balance sheet, we have accounts receivable over here. We have current liabilities, accounts payable, credit card debt. And this balance sheet is more directly pulled from QuickBooks, and that's most notable in the fact that there is the accounts receivable. And if you'll remember that accounts receivable is money that your clients owe you. If you're selling wholesale, you may have outstanding invoices. Accounts payable is what you owe your vendors. And these current liabilities are things that you owe within a year. And if you look down this list, you can really see accounts payable, what you owe your vendors, owe them within a year. You have your credit card debt, owe that as soon as possible. Federal taxes, owe that as soon as possible, you start incurring some penalties. Similarly with payroll liabilities and state taxes. Mortgage obviously is a long-term liability. You chip at that every month with your monthly mortgage payment. So that's not as immediate. But when I look at this balance sheet and I look at the current liabilities, I'm thinking, all right, well, we got $20,000 worth of liabilities that's due in pretty short order, and I've only got $18,000 in cash. So that's not quite enough to cover the current liabilities. But if you look down one line at the accounts receivable, you can see that this farmer has $18,000 coming in from clients, from wholesale customers. So even though he doesn't have the money in his checking account, he can feel pretty good that he's going to be able to cover these current liabilities with money that's coming in over the next few weeks and few months to cover those. Any questions at the balance sheet? So the question is, could labor be partially accounted for as cost of goods sold, especially harvest and post-harvest work? I prefer not to count labor as cost of goods sold, even though it is part of production, just because it gets a little bit messy to track the different types of labor. It's really hard to get your crew to, track what they're working on and when. Also, I like to just call out labor specifically. I don't want it to be mucked up with the cost of goods that I'm reselling, because that's a really important number by itself. And if we blend in the labor into that number, then we can't really see the nuances of those two different data points. So I prefer to keep labor separately. Similarly, you're going to have payroll taxes with labor, and it becomes really tricky trying to allocate payroll taxes to cost of goods sold and to non-production labor. And the payroll tax is really a part of your payroll and is the cost of having each employee. So for those two reasons, I really encourage you to keep labor separately, just in its own category, separate from cost of goods sold. So we looked back at the income statement and the balance sheet. We took a historical view of those two statements as a way to analyze the business, evaluate the profitability, explore opportunities to increase profitability, increase revenue. We can take this statement and then move forward and create a budget to look forward and plan for cash flow in the future. So what you do is you create a budget, you track your cash flow, you compare your budget to actuals, and we make adjustments. So let's talk about what we're going to do. So we're going to start with the previous year, and we can take that income statement that we had the previous year, and we can look at each line item and see what do we think is going to change from year to year. And then we can outline the revenue, expenses, capital purchases, and financing. And I'm going to just show you an example right here. So this is how we would do it. We would start with the actuals here. Oops, sorry. We'll start with the actuals here. We have, let's say in 2014, the farmer did $13,000 in CSA sales, and she thinks that she can grow to $17,000. Maybe she did $70,000 in farmers markets and thinks that number is going to stay a bit flat. Maybe the winter farmers market is increasing. Special orders, maybe that number is staying flat. So you can look at the previous year and make a determination of what you think you're going to do in a coming year. Now, once you make these determinations, you want to then say, all right, how am I going to accomplish that? I said I'm going to increase my CSA revenue by $4,000 next year, but how am I going to do that? How many new subscriptions is that going to be? What do I need to do to actually make that happen? And then you can plot out, what you think you'll do each month. And I'm going to actually just switch over to this spreadsheet because it might be a little bit easier to see. Okay. So here is the actual spreadsheet. So then you can just kind of plot out what you think you're going to do each month based on, well, I think I'm going to do $17,500 in CSA. Where do I think the cash is going to come in? And we can just, plot it out each month. I think, it's going to start in January, February, kick into high gear in March, April, May, taper off, and maybe get 1 or 2 sales later on. Similarly, you can kind of plot out the farmers market sales. What do you think you're going to do? Where's money going to come in each week, and so on. And then we can plot out the expenses in the similar vein. What do you think you're going to spend on animal feed based on last year, and where do you think it's going to happen? This farmer thinks that she's just going to make 2 purchases during the course of the year. So by plotting out these numbers, you can really get a good gauge of how your cash planning is going to go. And get down to the bottom, you can even plot in, if you think you're going to get any grants throughout the year, any capital expenses, and then at the bottom we have a total net cash flow. And we can track our cash flow, if we started out with $50,000 and the net cash flow in January is a negative $7,000, then we'll end up with 43. Then the next month you start with 43 because that's what you ended in the previous month, and then you had a negative cash flow of 2,400, so it's bringing down the cash balance a bit more. And to see a negative cash flow in the first 4 months of the year is not uncommon. That's when you have all your expenses and not a lot of revenue coming in. And that's why it's so important to do the cash flow planning in the beginning of the year so that you can make sure that you stay cash positive. It's easy to, come May, the money starts to come in, and it's easy to stay cash positive if you can get to that point. So when you do your cash planning like this, you can make sure that you stay positive. And if your ending cash balance dips below 0 at any point, then you need to go back up and make adjustments. Do you need to defer any of these expenses? You can go through each list, each item, and see what you can defer. You can go up to your revenue and you can see, well, what can I do to push my CSA revenue coming in earlier? Do I need to sell more at the winter's farmers markets? What can I do to change that? So you can use this cash flow tool to help project going forward. So we've taken a broad view of cash flow planning. Now we're going to take an on-the-ground view. Every week, every 2 weeks, you're paying your bills. You have your electric bill, you've got payroll, rent, you're paying off your vendors, and, you want to make sure that you're not bouncing checks, so you've got enough money in your checking account to cover everything. Maybe you're trying to pay down some debt, so you want to, stay on top of that. So I like to use this weekly cash planning tool as a way to make sure that there's enough money in the bank. So you can start at the top with your beginning cash balance. And this cash balance, you can get that from your checkbook register. You can get that from QuickBooks. If you look at your balance sheet on QuickBooks, that will also have your cash balance. Then you want to figure out what bills do you need to pay this week. So you can find that from your balance sheet by looking at the accounts payable. You can find the accounts payable also in your QuickBooks. You can run a report. So what bills do you have coming due this week? You may also have other payments expected. You may not have your payroll as a bill, but you may still owe payroll that week. Maybe the rent is due. Maybe you're planning a purchase, or you have an unexpected repair that you need to make. So you want to then lay out the projected expected payments. Then you want to project what you think is going to come in. And this is going to come in from 2 places. One is your wholesale customers that you're expecting payments from that you've noted on your balance sheet. And the other is the projections that perhaps you noted on the cash budgeting tool that we just looked at. Maybe you're going to the farmer's market this week and you're expecting $1,500. Maybe you know that on average you sell $500 a day at your farm store and you're going to be open for 3 days that week. So what money do you expect to come in? Finally, you want to be setting aside cash. Your economic reality is going to dictate how much you need to set aside each week, but I recommend setting aside something for unexpected repairs, for those months when you're tight on cash flow, for taxes, all those different things that come up that you want to have a little cash reserve. So if you can afford to put money away, put money away. So you start with your beginning cash balance, subtract what you need to pay out this week, what money is coming in is added back in, what money is set aside is subtracted, and then you have your available cash. Now in this example, the farmer has an available cash balance of $2,600 at the end of the week, which is great. She knows that she can pay her bills and her other payments this week and not worry about bouncing any checks. And she's got some money that she can either set aside for purchases. If she's trying to pay down debt, she can use this money to pay down debt. So she's in a pretty good place right now. Sometimes, though, the numbers don't really work out too well. You know, maybe you have your credit card bill and payroll and rent due in the same week, you know, which can make for some very big projected expenses. And maybe you don't have a lot coming in. You know, maybe it's May, so you've got a high payroll, but you don't have a lot of money coming in from sales. So sometimes the numbers don't really work out as well. And in this case, you know, the cash available is a negative amount, which means there's not enough cash to be paying all these bills despite the money that's coming in. And even if we cancel out the money that I suggest you set aside every month, there's still not enough. So that's going to mean that you have to look at these numbers and make some decisions. You know, depending on what these payments are, you know, maybe one of the bills that you owe is to your seed supplier that you're good friends with and you've been a regular customer for many years. Maybe you can defer payment. You know, maybe there's a week wiggle room. You can delay your rent by a week. You certainly don't want to delay paying your employees. You can also think about what you can do to increase your cash coming in. But even though this number is negative and it can feel really difficult, having this information allows you to make decisions about what you want to do with your cash and how you're going to make adjustments. So you can make an informed decision to either delay or ramp up revenue based on this number here. Now, the thing is that, you know, if your cash available is consistently low, you know, if you whoops, we're not quite ready for questions. But if you find that your numbers are, you know, you're consistently short on cash, then you're going to need to revisit your cash plan and your budget to see what you need to do to make changes. Because if you're consistently short on cash, then the hole is going to start to get deeper, and you know you're going to be delaying payments, and you're going to be getting behind and incurring interest expense. So it's okay, you know, 1 week you need to sort of juggle things around. But if you're noticing that you're consistently short, then you're going to need to go back to that cash budget and see what adjustments need to be made. And I'm just going to remind you of this cash budget. So, you know, if you find that you're consistently short despite, you know, having gone through this whole plan and you see that your ending cash balance you had projected to be positive the whole time, but you're doing the weekly cash plan and you find yourself in a negative situation, then you need to go back and revisit these numbers to see what happened and where did things go wrong. So any questions? Are there general rules accompanying fixed assets for things such as buildings and farm stand, is it worth it to appraise? So I'm not quite sure what this question is asking, but I'm going to take a stab at it. In terms of creating a value for your fixed assets to put them on the balance sheet, typically the value of your assets is based upon what you paid for them. So if you bought a piece of land for $100,000, then that is the value of the land on your balance sheet. If you put improvements into the land and it's a capital improvement that you want to show on the balance sheet, then that's where that number comes from. So the value of your assets on the balance sheet is really coming from what you spent on them less any depreciation. So your accountant has been helping you to calculate your depreciation expense every year, and that's going to be reflected on the balance sheet in terms of accumulated depreciation. Where would you put medical insurance? Is that under owner's draw? Medical insurance, I assume regular health insurance, I consider that a payroll expense. It's, what does it cost to maintain your employees? And your health is part of your maintenance. And I consider that a payroll expense, part of payroll and benefits. If you feel that your company, your business should be paying for your insurance, then that would go under payroll. If you think that your business should not be paying for your medical expenses, then that would go under owner's draw. Are there different ways to break out payroll for classification of employees, such as salaried, intern, custom hire, and where would these go? Yes, absolutely, you can break out payroll. Some people like to break out payroll by salaried employees versus hourly employees, or contract labor versus employee labor. So certainly you can break out that, and I would keep them all under the payroll category. So you have the broad category of payroll, then you can have the different types of payroll expense, such as salary, hourly, interns. Then you also have your payroll taxes, the state Medicare, unemployment insurance, workman's comp. All of that is under the broad category of payroll expense. For new farmers and new farm enterprises, are there common pitfalls with their projections? Yes. Common pitfall actually is that farmers underestimate the expenses, and more common is that they just sort of forget about the little niggly $10 here and $10 there, and oh yeah, well, the phone bill, whatever, yeah, okay, that's no big deal, it's only $20 a month, or yeah, the $20 bank fee per month, no big deal. And all these little expenses, $20 here, $20 there, a few of these expenses, and you're starting to talk about real money. So it's easy to sort of brush off a couple of dollars here and there, but too many times it really adds up. So I really encourage farmers to really think about every single expense and don't discount anything. So when is it suggested to update your balance sheet? If you're using QuickBooks, QuickBooks is automatically going to track your balance sheet, so you don't have to quote-unquote update it. You can just run a report in QuickBooks, and I find it helpful to look at my balance sheet, once a month, just to see how things are changing, and keep an eye on my accounts receivable and my accounts payable. If you are not using QuickBooks to track your balance sheet, then you probably want to put it together once a year and take a look at it that way. Certainly when you're doing your end-of-year planning and trying to understand, where did your cash go, taking a look at your balance sheet is a really good way to do that. Well, I guess that's it. I want to thank you all very much. I hope that was helpful. Certainly you can feel free to send me an email or give me a call if you have other questions. If you want to visit my website, I also have Some of these tools, these cash planning tools that we discussed here today, are available on my website, and along with a few other videos and other tools. And thank you very much.